Okay, so there's another little subtle sign that has occurred. And to me, that just once again strengthens or bolsters the position of where we're going with this housing market, the bubble bursting, massive foreclosures on the way, etc. We'll talk about that and more in a second here. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today's the 23rd of December, just before the holiday break. Hope everyone's doing well. I thought I'd put out this one last video before the holiday, for the Christmas break, and we'll do more obviously over, once the 26th hits, etc. But I saw this yesterday, and I thought this was really a very positive sign. So that's the scoop. We're going to talk about that. Randy Patrick here, your host, putting the realism back in real estate because nobody else is. Simple as that. All right, guys. Here's the scoop. And by the way, if you enjoy the content of this channel and you're not already a subscriber, if you could do me a great favor and maybe give me a Christmas gift, smash that subscribe button, help my channel grow. I would really appreciate that. So thank you. So anyway, let's talk about what's going down today. All right. And for me, I like things. I look for things that are maybe under the radar and aren't very prevalent or talked about maybe in the news media as signs. So I don't know, this is a scene from the Mel Gibson movie Signs. I always love this, and I like to put this picture up when I see another sign. And the whole point, though, is that there's little things that go on in the housing market that sometimes do go unnoticed, but they actually have significant impact, or there's maybe some telling information behind the scenes that we should be paying attention to. So what just occurred? Well, we know what was the big news yesterday and the day before is the stimulus bill, right? So yes, it's not passed as of yet. Congress put it forward. I think the president already kicked it back with respect to making some changes. But, of course, when you're looking through all the rhetoric and what they call it pork and stuff like that through the bill, there's these little nuggets. And this is what we're going to talk about right now. And again, I'm trying to make this video quick as possible here. So this is a headline news release from National Association of Realtors, basically saying that realtors' efforts help secure rental assistance in the COVID-19 relief legislation, which is great. So obviously they're lobbying and doing certain things with the government to get stuff that's pro homeowner, pro renter, things like that. So, it basically was, the agreement of providing $25 billion to states through September 2022 for rental assistance and things like that. But there was something at the bottom that caught my eye, especially for how I like to position the real estate market and where things are going to head in the future. So this is what I call the sign. So this is more specifically what they were talking about in this press release. All right, stimulus payments, unemployment assistance. But where that red arrow is, it says extends for 5 years the exclusion from income for mortgage debt forgiveness. All right, and permanently extends the energy efficient commercial buildings deduction. The key part is that first part of the sentence. Extends for 5 years the exclusion from income for mortgage debt forgiveness. So let's go back history here, okay? So if we go back, when the housing crisis first came out, this is back in 2007, where people were losing their homes to foreclosure. They were doing short sales to get out of their over-leveraged debt and everything. What the lenders and banks were doing is they were sending homeowners 1099-C tax statements at the end of the year. So for example, if you owed $250,000 on your home at the time of the transaction, whether it was a foreclosure sale or a short sale or a deed in lieu or whatever, and for whatever reason it was purchased or what the lender earned on it was $200,000, there would be this $50,000 delta, this difference that you owed that was not paid to the lender. So you're on the hook for that. So the lenders basically said, okay, well, we took the loss for it. So what we're going to do is we're going to assign this to our homeowner, the person who held the mortgage, as income, because in theory, we as the lender or bank forgave the homeowner the income of $50,000 or whatever the amount was. So people were getting these 1099-Cs, which essentially is a taxable event. So the concept is, well, I get a 1099. Okay, I have to, filter that through my taxes at the end of the year. What am I going to do? I'm already insolvent because I couldn't pay for my mortgage. I just lost my home either to a foreclosure sale or a short sale. I don't have the cash for it. It's like beating up, it's kicking someone when they're down, right? Just keep on punching them when they're down. making it difficult. So the government did a good thing in 2007. They enacted what was called the Mortgage Debt Relief Act, which took care of that. They basically said if anybody got the 1099-Cs for the primary home residence, they didn't have to pay it. That was a good thing. So that act went on for a little while, all right, and then basically what happened is that it expired, then it would extend for a year or 2 years here and there. So basically, it's back now, and I guess this is what I want to talk about here in this video. So what is the significance of this, and why is this so important? Well, from my perspective, when you're dealing with distressed properties, and you're looking at what's going to happen down the road, starting in 2021, in some locations it started already, but it's significant because they know what is going to occur over the next few years. What do I mean by they? They is lenders, banks, the government, the mortgage companies, the data companies, all these people who are, pro housing, housing involvement, organizations, whatever. They know that, this is going to be a problem. So when, they're not actually coming out on the media saying there's a problem here. I mean, there are certain groups there are certain data companies who are producing the data to let us see what's going to happen in the future and look at the volume that's coming. And I think that's very, very positive because it wasn't available before. So now we kind of see what's coming down the road here, right? Hitting down the tracks. But the whole point that, they know this is going to happen. So it's almost, to me, this is a subtle admission that yes, we have underlying issues, even though we're not talking about it now. In the current housing market setup is trying to, keep those underlying issues kind of in a state of suspended animation or in limbo right now. Let's just keep buying the properties and having low interest rates and trying to crank the economy as best as we can. But they know that this is going to be a problem. So that's why that is in there. So we're not talking about giving money to other locations. I'm sure most people who are on this channel have seen some of the crazy stuff that's being asked for money leaving the country, for weird, just stuff that probably a lot of us don't agree with, which is understandable. But I look at it going, they, again, the people with powers that be, already knew this would be needed to assist homeowners. They already knew this. They actually knew this last year. And this is what I want to get into right now. So this is, remember this slide? So I've shown the slide, previously, and I actually did a Facebook live stream on Monday night, the past couple days ago. So you want to go see that live stream, go to the Facebook page at Housing Bubble 2. Yes, I know people are going, I don't do Facebook, but guess what? It's almost a 2-hour presentation and discussion and question and answers. I don't do that on YouTube for some obvious reasons. It doesn't cost you any money. You can go check it out if you want. All right. But remember the slide, because where's that red arrow? What's it pointing to? What could the next 5 years look like? Okay. 1.8 million to 2.3 million completed foreclosures 2021 to 2025. This is a conservative estimate coming from the people from auction.com. Okay. So listen, this is what the data companies are saying. I think it's conservative because some of the data they're using is based on Black Knight Financials data, which I do believe is conservative and underreports some of the data as well too. So the whole point is there's going to be, and again, this has been revised in discussions to 2.5 to 3 million or even more foreclosed properties, foreclosures, whatever, in that kind of ambiguous foreclosure world, right? The point being, this is important. And look at the dates, 2021 to 2025. So do you think it's a coincidence that, they say extending the Mortgage Debt Relief Act in theory, it's called something different now, we'll talk about it in a second, but extends this for 5 years, which basically means, if it's your primary residence and, you're going to have an issue with a short sale or foreclosure, you're going to have this phantom 1099 debt getting hit to you that you're not going to have to worry about that. You're not going to have to pay tax on that. It's going to go away. It's taken care of for you. But the whole point is everything lines up, doesn't it? So we're looking at, Adam or auction.com talking about, 2.5 million, other people talking 3 million foreclosures, foreclosed properties, whatever. It's a lot of stuff that's going to be happening the next, 21 to 25. So I'm looking at this, I'm going, okay, let's do some math. I don't like doing math in public, but, 2021, 2022, 2023, 2024, 2025, that's 5, right? That's 5 here, 5. So, this is like Sesame Street, guys. So, and funny, they're extending this moratorium for 5 years. That's the extension. It could be extended after that fact. So that's what they're tabling here, which, again, as much as I'm saying this is an admission of yeah, we're going to have problems, from a homeowner perspective, this is actually a good thing. So this is something that should be applauded, that there is a recognition of this at some level of government, people, whatever, powers that be, that there's going to be issues, but everything is lining up, and that's how I look at this. So again, one more is just a subtle admission of what's happening. Now, This was an article that came out this time last year, almost a year ago. Okay, look, basically, and again, I want to go through this because it's important and it kind of revs things up here. So, the Mortgage Forgiveness Tax Break Act was actually put back into play this time in 2019. All right, so it actually was extended, from 2007 and to 2010, and to every couple of years. Then it had 1 year extensions. Then, kind of like 2018, after 2017 and 2018, it did not get extended. So the Mortgage Debt Relief Act did not get extended. And it was kind of like, that's odd. And I think some of the basis of this was, well, the market's great, so people shouldn't have this problem. If they're facing foreclosure, they should sell their property with all their equity and pay stuff off. They're not going to need this, right? So that was kind of how it kind of played out here. But if we go back to this time last year, okay, so we're in December of 2019. So what hasn't happened, at least from a public awareness perspective, in December of 20th, 2019? It's called COVID-19. All right, the pandemic. The pandemic wasn't really. It probably was physically here and was starting. We weren't aware of it. But the point, though, was that it wasn't a talked about, shut down, situation, wear masks, the whole bit, people, going to hospitals, whatever. So the chaos wasn't quite here yet. So I look at this going, somebody knew that going forward in 2020, there was going to be problems. All right. So essentially what happened is the president last year signed this kind of recreated this act and put it in place. So it's no longer called the Mortgage Debt Relief Act. It's called the Qualified Principle Residence Indebtedness Exclusion, the QPRI. That's a bit of a mouthful, but the whole point, though, is this exclusion allows some taxpayers who've had mortgage debt forgiven, like after a foreclosure, loan modification, short sale, or deed in lieu of foreclosure. They have covered the whole gamut there, to exclude the canceled amount from their income for federal tax purposes. So if you receive a 1099-C, the cancellation of debt from your mortgage lender for the 2019 year or for the 2018 year, they're going to waive that. So what this act did was basically say, we're going to extend this or recreate this for year 2020, which we're in now, but they also went back retroactively and took care of the 2018, 2019 because it wasn't taken care of there. So essentially, they basically said, this, we're taking care of the homeowners, which is good things, which to me means that they already saw what was going to happen with the housing market prior to this pandemic. So even as I mentioned in my videos, I've been doing these videos really since 2018, talking about the housing bubble. You could already see the cracks of the housing bubble. You could already see where things are ramping up. Price point wise, you could already tell that FHA loans were the number one loan segment out there. You could also tell where foreclosure filings were starting to amass and bubble, where the defaults were. So if you were looking at that point in time, you could see that, yeah, there's going to be some problems here. The pandemic just basically accelerated that. So this was in place prior to March, when all the stuff kind of hit us, right? All the shutdowns, the forbearances, whatever. So when we look at this, what is the Qualified Principle Residence Indebtedness Exclusion? If a mortgage lender forgives all or part of a borrower's debt as a loan modification or after foreclosure or short sale or deed in lieu of foreclosure, the forgiven amount is generally included in the borrower's gross income that could result in the tax liability. Okay, now because they treat these discharged debts as taxable income. So what this does is the QPRI exclusion allows some borrowers to exclude up to $1 million or up to $2 million for a married couple for forgiven debt from a taxable income component here, right? You have to meet the qualifications for the tax break, like the forgiven debt was used to buy, build, or substantially improve your principal residence. You won't have to pay income on that taxable forgiven amount. Now, the difference is, so say you did a home equity line and you pulled up $50,000 and you bought a boat with that. Okay, you know what? That's not going to be forgiven, all right? So read it. It's used to buy, build, or substantially improve your principal residence. So as I said, this is a very positive thing for homeowners, especially as we see this potential up to 3 million or so foreclosed properties that's going to be happening the next little while. So over the next couple of years. So this is what's going on. So I do think this is very positive, and I think that this is yet another reason why people, like, they know it's going to happen. They know that we're going to see foreclosures. They know there's going to be more short sales. There's going to be all sorts of stuff going on. So again, remember, I'm talking about this article was written a year ago. All right. So as you can see, it was the QPRI exclusion was first introduced in the Mortgage Debt Forgiveness Act of 2007. It was good for 3 years. It got extended, whatever, and it kind of ended 2017. So now the new law exclusion applies to debt discharged, before January 2021. Okay, so this takes care of the year. So this exact thing takes care of year 2020. And this new, I guess you could say, part of the stimulus bill is extending this for 5 more years. So taking care of year 2021, 2022, 2023, 2024, and 2025, which perfectly lines up with that one slide we got from auction.com showing how the foreclosures are going to be growing starting 2021 all the way through and into 2025. Okay, so again, as I say, things are lining up. Kind of like the celestial event we had the other day, right? When Jupiter and Saturn kind of align and look whatever they call the Christmas star, etc. So basically, things are lining up. So again, not a big deal for the media. Who's going to pick up on this? Probably nobody. I pick up on this stuff because this is what I look for. So for me, again, in summary, this is a very good thing for homeowners. This is going to help homeowners who are going to have issues. And one more reason why you guys should be looking at short sales to do business and buy properties, etc. Okay, so as we all know, 2 housing narratives in play, K-shaped housing market. The housing market is stalled, very little inventory left. The bottom part of the K is not being allowed to take place at this point in time with a lot of the moratoria that have been extended, etc. But we are seeing certain locations open up, like where I'm in Florida and a couple other states as well too. You're seeing more and more foreclosure auctions being scheduled. This is how we can help people with what I just spoke about right there. Okay, guys, so that's pretty interesting. So again, as I always mention, I'm repetitive. There are properties available right now. You just have to look where. My last video, the distressed sales, that's where the opportunities are because nothing's going on with distressed sales, which means they're all under the radar, shadow inventory. This is where you have opportunity to either earn income, get property, flip property, do what you want with it, get a primary residence, whatever it is. Okay, distressed sales, they are bank owned, which is called REO, real estate owned. They've been taken back via the foreclosure and put out in the MLS. And short sales are pre-foreclosure, before it's been foreclosed on, trying to get a settlement on debt to relieve the owner of the foreclosure issue. That's what the distressed sales are. There's going to be a lot more that's coming down. What is the starting point for distressed sales? Well, we're in the starting point right now. Mortgage delinquencies, we got a ton of them, all right? And there's a whole bunch that aren't even being taken care of by the forbearance plans. We got 2.7, 8, 2.5, whatever the number is today. It ebbs and flows every week. We have 2.7 million people in forbearance. 80% of those are re-upping or re-up their forbearance plan. They're going to have issues. They're going to be part of that 2.5 to 3 million foreclosures in the future. Okay, we have foreclosure filings and notice of defaults. That's a starting point as well too, and foreclosure auctions. So this is what is part of the complete distressed property profile right here. So again, this is where the opportunity is, and from what I'm seeing here, and from my perspective, this inclusion of the extension of this what's called the Qualified Principle Residential Indebtedness Program, otherwise known as the Mortgage Debt Relief Act, is a subtle admission that we're going to have problems and the market can't fix itself. Simple as that. All right, guys, just connect with me if you want more information, discuss things about doing business, buying properties, investing in this marketplace. I can help you all the way here. So connect with me right there. I'm around all holidays just doing what I normally do. I do find people are obviously more available, so I can talk to everybody and engage, whether it's email, text, or phone calls. I'm available for that over the holidays here. So anyway, wishing everybody happy holidays, a Merry Christmas, a Happy Hanukkah, I guess you could say Happy Kwanzaa, Merry Festivus, whatever we'll call it, whatever you subscribe to. Enjoy the holiday season, be safe, and we'll look forward to speaking with you in a couple of days.